Hey, what's going on? Samuel Joseph here for Elevate Forex, and in this video, we're going to be talking about structure. All right. So here's my promise to you. At the end of this video, you should be able to know what structure is, that is to define structure, to distinguish the two kinds of structural delivery, and to determine how to apply, the principles behind structure to your trading. All right. So let's jump right into it. Why is this really important? Now, there's something I want you to realize, that to be able to trade, right, you're looking at the charts now, or you're studying this course because you want to know how to be involved in the market. So there are some key things you need to take away. One, you need to know where price is, that is, and you can be able to do that by simply looking at your charts, right? Two, you need to have an idea, that's a pre-informed knowledge of where price is heading to. You get that? You need to know where price is. That's the first. Secondly, you need to have an idea of where price is heading to, and you need to understand how to get involved in the market. That's to place your trades based on this informed idea you have, and that's why we're talking about structure today. Okay, so what exactly is structure? It's simple. Structure simply refers to the delivery of price with highs and lows in the market, right? Once you see something like this, you see structure being delivered like this. We have a high, we have a low, we have a higher high, we have a higher low, a higher high, a higher low, or the reverse could be the case. We could have the markets trending like this instead, right? This is just bear in mind, this is one variation. This is one of the things you might see. This is one of the ways you could see structure being delivered. You can have a high, you have a low, you have a lower high, a lower low, a lower high, a lower low, lower high, lower low, and so on and so forth. So what exactly is a high? What's a low? When we talk about highs and lows, we're talking about the areas in which price reversed on the chart. When you're looking at the chart, you see that there's usually a push, and then at some point you see that price reverses. Those areas are key structural points, right, where you tend to see price reverse before it keeps continuing in a particular direction, or if it changes direction, whatever the case is, right? Those areas that produce a higher low, if you observe carefully, you see that this was a high point in the market and this was a low point in the market, just like this was also a low point in the market. But when price pushed to the upside, it made another high point of this price movement that was higher than the previous one to sustain the higher high, while this is a higher low because it's higher than the previous one. Then this is a higher high, higher than this one, and then this is a higher low, higher than this one, of course, and so on and so forth. So why is this important? Why are we even looking at this before talking about structure? Because this forms the foundation of price movement in the market, right? Structure forms the foundation of price movement in the market. Now, price will continue to move like this in a particular direction until it doesn't feel like moving in that direction anymore, right? Until it doesn't want to move in that direction, it will continue like that. So having an idea of these points in the market is how you're able to make use of structure to your advantage. Having an idea of where these areas, where price is most likely to return, answers the question to the things we're talking about. We're talking about having an idea of where price is going to. So having an idea of structure, or knowing what structure is, gives you this idea of where price is likely heading to. All right, let's move on. Now, another important reason why structure is important is because it identifies the trend. What do I mean by that? What is a trend in the first place? Let's go ahead and talk about that first, shall we? Right, what exactly is a trend? Now, a trend is just simply the direction of movement of price in the market. It's just the direction that price makes. So if you see price moving like this, it's moving, right? Is there any particular direction? Not really. This brings us to the definition, or to the types of trend, the kinds of movements we have in the market. We either have price moving sideways, we say it's consolidating, or we have price moving like so, like what we described earlier on. So we can say price is either consolidating, just moving from right to left, from left to right, yeah, or we see price moving in a particular direction, either up or down, like so, right? So we either have it consolidating, let me take that off, or we have it trending. So once price is delivered with series of higher highs and higher lows in the market, we say it's trending upward. So one of the characteristics of being, or let's say one of the major things you use to identify an uptrend, which is also an importance of structure, to identify that, okay, I want to get involved in a buy trade because the market is moving upward, is seeing price creating higher highs and higher lows, imputing higher highs and higher lows in the market. When you see this, you can now say, okay, this is an uptrend. The market is moving in an upward direction, and most of the positions you'll be looking to get into would be longs. You'll be looking to buy, right? Because the market is moving to the upside. So this has given you a direction, an idea of the direction. This is an informed idea that, okay, this is the direction that price is headed, upward. So I would like to be looking for opportunities to buy in this kind of market, right? And similarly, the reverse is the case with a downtrend. When you see price constantly delivering lower highs and lower lows into the market, like so, imprinting such things, we have, what do we have here? This is a high, a low, a lower high because it's lower than this one, a lower low, another lower high, lower low, lower high, lower low. What do we say? We say price is trending downwards. So we can characterize a downtrend by simply identifying lower lows and lower highs in the market, structural points, lower lows and lower highs in the market. Then we're able to say, okay, the market is, in a downtrend, right? So you can now see how structure helps you to identify the trend, thereby giving you a direction or an idea of the direction that the market is heading, right? Let's take a quick recap. So far, so good. What have we talked about? We defined structure. We said it's just simply the delivery of price with higher highs and higher lows in the market, with lows and highs in the market. Pardon me. Lows, these are lows, higher low, and this would classify what? Yeah, if you said it together with me, an uptrend, you'd be correct. Yes, that's an uptrend, and subsequently, price moving like so, creating what? A downtrend. Where are the structural points? Right here. Now I know everything looks very clean. This is, like I said, there are different forms of structural delivery. So this is more of the textbook approach. We're going to be taking a look shortly at how you see it on the chart, right? All right, so let's get right into it. Now we're talking about how to distinguish between structure. We just talked about the first kind of structural delivery that you tend to see, this easy one. I call this the textbook approach. But usually the market doesn't, deliver price like this all the time. With things like this, you get to see stuff like trend lines. Let me even make it look very perfect, because this is how you most likely see it in books, right? It looks so perfect, obeying a particular trend line. So you just believe, okay, I'll just draw a line. Whenever price touches this point, I'm going to buy again. But when you get involved in the market, you now come to discover that it doesn't really happen like this, right? What you're seeing is not what actually takes place in the market all the time. You kind of see movements like this. You see something like this, right? And then you see something like this. Let's leave it there for now. This is an example of the other variation of price that you see in the market. And so far so good. The first one is the first one you see all the time, while this other one is what you would most likely see when you're looking at the chart. So this is a more realistic approach. But does that mean we don't have structural points being put into place? No. On the contrary, let's look at it. We have structural points here. We have one here. We have one here, here, here. Matter of fact, we have one here. Depending on if this move is going to create, a higher high in the market, we can call this a structural point, right? So even with this, you still get that that opportunity to be able to identify structural points in the market. Now I choose to look more at, or to focus more on this kind of price movement. Why? And I'll explain that in a bit. Now there are different theories that you could utilize in engaging the markets, right? We have the Dow theory. It just talks about price being delivered like so, highs, lows, highs, lows, highs, lows in the markets, right? But we're not going to talk about that. We have the Elliott wave theory. When we see Elliott wave, you see movements like this. Let me go ahead and put that. You see the wave one, wave two, wave three, wave four. with 5, and then you see the corrective move, that's A, B, C, something like this. I may not have drawn this perfectly the way it is, but this is what Elliott's theory postulates, you that price moves like so in the market. Then we have the Wyckoff theory, and the reason why I'm bringing this up is because there's a terminology in the Wyckoff theory I want to call our attention to. That's the idea of the composite man, right? So Wyckoff believes that there's someone in the market referred to as the composite man, and the composite man is that person in the market. Right, it's just a theory, like I say, it's just an idea. Like there's an idea of a person who has more money in the market, and he's the one who controls price, determines how price is going to go, right? And he does this by engineering liquidity, taking out that liquidity, and moving in the direction that he deems fit. I don't want to get so much into the use of a lot of complex terminologies, but I'm sure you must have heard of liquidity before. But if you haven't, just sit tight. In subsequent videos, we're going to be explaining more in detail what these concepts mean. Now, when you see price move like this, the idea is the composite man gets involved with a lot of buys in the market, right? And then as he's buying, he's constantly selling at the same time. And then he gets a lot of people involved in the market, that's the retail traders. Now he gives them the idea that price is about to reverse here. Why? Because you see classic patterns like a double bottom, and then you have your stop losses just below. What happens is the composite man now sells into these areas. Why is that? Because he wants to get involved in the market at lower prices, at discount prices, while you're buying here, while the retail trader, right, is buying at regions around here and having his stop losses here, which means if price goes beyond this point, he's selling out of that trade. He's selling his order. He's selling what he bought at this point at a lower price, which means he's taking the loss. And this loss that he's taking now was engineered by this composite man by driving prices lower, because remember, he has a lot of money and he's taking the market in the direction he wants, and then drives price higher. You saw that he took price lower first to buy at a more cheaper price, and then took price higher. Why is he doing this? Simply because he wants to make profits from the market, right? And then he keeps delivering price in such a way that he takes out liquidity. What I mean by liquidity now, we'll talk more in depth about it in subsequent videos, but I'm talking about like your stop losses, you getting out of the market right now. That's the liquidity that was engineered in the market. It has been taken out and price has continued in that direction, right? That means he has bought, but he bought at cheaper prices than you did. You panicked as a retail trader, or the rest of the people trading the forex market, the spot forex market. They sold at lower prices to the composite man. He bought at lower prices and therefore took prices higher, right? So he's making a profit. Now, however, while this happened, he sold heavily to be able to drive prices lower. It now leaves behind a region known as a demand zone, and this is where the idea of zones come from, demand and supply zones. You can see this corresponds to certain level of structure. Now, he wouldn't want price to go lower than those zones. Why? Because now he would be in a loss, because he sold heavily here but bought heavily as well. He's been constantly getting involved in the market as price keeps going up, buying and then offering higher prices until price kept going higher. And now if prices drop below those areas, he will be holding a terrible losses. Thus, he's obliged to try to maintain price above this area. Let me go ahead and take this out. He's obliged to try and maintain price above this point. That's this point over here, right? So that he's not going to be in a loss. Thus, the lowest point that the composite man is going to drive price was at this zone here, thereby making it a structural zone, an important level of structure, before eventually continuing the ride to the upside. I know this could be a bit confusing, but if you don't, just try and watch this video again. Just listen to what I said again and try to get a major understanding of this concept, right? It's a principle that has held for a very, very long time, for hundreds of years, right? And it was first talked about by Richard Wyckoff. It's a very interesting principle. So we talked about a a zone that is now usually created. Let me go ahead and draw that out again. So we have this, we have the double bottom, right? Liquidity being engineered in the market, making people feel that price is about to take off, and then those areas get sold into, leaving behind a zone here, usually referred to as a demand zone. And then usually what he does sometimes is he comes back to mitigate those others. I would explain what mitigation means in just follow me, right? And then drives price higher again. And this now characterizes a trend, right? You can still see the structural points still put in place. At the structural points we have, whoops, sorry about that, we have this point, we have this point over here. These are structural points that have been put into the market. Now you would see that the composite man will try as much as he can not to put prices below these areas so that he's not holding a loss. And this just goes to, you know, reinforce our own idea of trading. How do we take advantage of this? Our knowledge of structural points, or our knowledge of structure, helps us to get involved at the proper areas, right? Where at discount prices, that's if you're buying, or at premium prices if you're selling. I don't want to all of this is falls under a smart money concept, right? It's a style of trading too, where we talk about the composite man and a whole lot of that. So an idea of this, of structure, how structure plays out, helps you to identify the areas where you should be buying from or selling from, depending on what structure you have in play. If it's an uptrend, what structure has told you, rather. If it's an uptrend, you'll be looking for those areas to buy. So now you know that you are getting involved in a buy. You want to buy that particular pair, right? And you also know areas where you would most likely be looking out for buys from, demand areas. There's so much that we're going to talk about this. Just stay with me, right? So let's take a recap of what we've talked about so far. We talked about the distinguishing features between the textbook method of price delivery, right? We talked about seeing price deliver in a more typical way, like so. Let me go ahead and draw that out. Having price move in such a manner like this, right? And we said we don't see this every time, we just see it happen in textbooks. And then we talked about the second form in which we could see price, which is more like this. So we have these two kinds of price delivery basically, and it's the same for both an uptrend and a downtrend, creating demand zones in, you know, in an uptrend, usually when we are looking to buy, or supply zones in areas where we're looking to sell, right? And we said this idea was brought about by, you know, trying to get involved in the markets the way the institutions get involved, the idea of the composite man, right? So now, how do you apply all of this to your trading? How do you utilize this knowledge now to be able to trade profitably? Let's say, yeah, I heard you, coach. So how do I utilize this for my trading? Now, it's important to note that structure alone is not it's not advisable to utilize the idea of structure alone for your trading, but it serves as the framework for which you'd be able to plan your trades. Having the institutional trading idea at the back of your mind, you can simply position yourself at those structural areas, right? Because you now know that, okay, this is the structure that is being put into place. You now have an idea that this is what you should be expecting in the market. You know how to position yourself to be able to execute orders, and this should be at, you know, these demand zones in case of an uptrend, or supply zones in the case of a downtrend.